I'm Sergio Aranda, eBuilder Product Marketing Manager, and I'm excited to introduce our speakers, Mr. Patrick Duke, Senior Vice President with the KLMK Group, and James Vermeulen, Co-CEO, Chief Technologist, and Lead Cost Engineer at Vermeulen's Cost Consulting. Moderating today's presentation is Jonathan Entevi, eBuilder CEO. Before I turn the mic over, I'd like to introduce our speakers for those of you who are new to our webinar series and our respective organizations. James Vermeulen has been involved in the estimating industry for the past 27 years and is responsible for the overall scope of work for the project that he works on, including all versions of the estimate, from draft to final estimate at each of the design stages. James' primary responsibility on the project is overview, review, and reconciliation, as well as providing high-level client support. James also takes a very active role in reconciliation and value engineering meetings and maintains current data and projections for construction pricing levels. Patrick Duke is Senior Vice President at the KLMK Group, and in his role, his focus is to ensure that all KLMK team members have the proper tools and time commitments to meet project requirements. Patrick's technical strengths include program management, project team coordination, construction administration, design management, equipment coordination, and contract negotiation and administration. John is CEO of eBuilder, providers of web-based capital program and project management software. Since June 1995, John has been featured over 30 times in Engineering News Record, and in January of 1996, he was nominated by McGraw-Hill and ENR as one of the top 25 newsmakers of the year for being the first to move practical construction applications onto the web. More recently, John made the list of 20 people and groups impacting Virginia's commercial construction in 2011 and beyond. John, I know we got a lot of information to cover, so let me turn it over to you.
Thank you, Sergio. I was looking through the slides that James and Patrick submitted, and for those that really like the economic aspect and the facts and the data behind a lot of the words in the presentation that you're about to hear, they're really going to enjoy this today. Those of you that don't know, KLMK, of which Patrick Duke is associated with, is a consulting firm dedicated to managing the facility, planning, design, and construction process for healthcare owners. And James Vermeulen provides independent cost advice to owners and architects regarding complex institutional projects in healthcare and higher education at all levels of government. And I think Patrick will talk more about this next year, but on complex projects, KLMK has worked with James Vermeulen and his group, and they're usually brought in as part of the team to provide another opinion on cost. It's my understanding that James and his group are estimating typically 3 to 4 times the amount that a typical construction manager is. They understand the economics and how that information relates to the construction market. So without further ado, I'm going to transition over to Patrick, and I want to let everyone know from a ground rules perspective, each of you in your GoToWebinar panel can go ahead and ask questions in the chat or questions section. Those will come to me, and during the appropriate pauses in the presentation and along the slides, I'm going to pop in and ask James and Patrick those questions. So please, the whole goal is to make it highly interactive, and we aim to do so. So Patrick, without further ado, let me turn it over to you.
Okay. Just wanted to jump into the agenda and talk a little bit about what we're going to cover today. We are going to talk a little bit about today's construction cost environment, look at the driving forces, what's behind the decline in prices that we've seen, what's behind what could be a glimpse of the future, and that means we could be looking at cost rising. All that sounds logical, but what we want to do is arm you with real data, real facts, look at the general economic health of the United States and how that relates to the construction markets. So we think that's going to be valuable information for you to consider. And then we want to also offer you at the end a process to consider as you look at large capital projects that are very complex, how you can get some insurance on the numbers that you're getting as market volatility rises in the future. So those are the things that we want to review today. All right. I'm going to turn it over to our partner, James Vermeulen, and he's going to go into the construction cost environment today. So, James, if you would, take it away, please.
All right. Well, thank you, Patrick, and really happy to be here on today's presentation. There we go. Okay, so we maintain our database, as John indicated. We work on a lot of projects all across the country. In fact, the number of projects we work on is around $5 billion worth of annual construction volume, which is similar to Turner Construction and other large construction managers in terms of overall construction volume. So we have a large database, and we track all the different trades, and here's an example of different components within certain trades and what has happened from the peak at the end of 2008 to the bottom last year. So what we do with all of those numbers is we take a typical institutional project and we do a trade-weighted average of all of the declines, and what it worked out to was from the peak at the end of 2008 to the bottom last year was an overall 14% decline. And since that bottom till today, we are up 2%. And if we go on to the next slide, in true Vermeulen fashion, we always want to reconcile with one of our construction manager partners, as we do on projects all across the country. And so Turner Construction, as it happens, has a construction index, and this is a screenshot of their index. In fact, the third quarter of 2011 is out also, and as you can see that roughly each one of the quarters since the last quarter of 2010 has been in the 0.4 to 0.6% per quarter cost escalation increase. And their overall peak to the bottom in the third quarter of 2010 was 13.2% down, which is very similar to our 14% down. And what's interesting about this chart and our data and whatnot is showing that 2010 was in fact the bottom, and that we are inching our way off the bottom. We're kind of bouncing along the bottom, where sub-trades are now in the position where they can no longer afford to absorb all of the various labor and material increases and are passing those on to owners in the way of bids, which is translating into this 0.4 to 0.6% per quarter cost escalation in the current marketplace. So I want to take you back to a budget example, and I want everyone to sort of suspend their knowledge that they were blissfully unaware back in the third quarter of 2008 that financial institutions can, in fact, go bankrupt. And if you had a $100 million project back then, and you were asked to escalate. Yep.
James, can financial institutions really go bankrupt?
Well, that was the message that Wall Street delivered loud and clear in the fourth quarter of 2008. And but prior to that, in the third quarter of 2008, if we had a $100 million project, collective wisdom from the past 4 years was the escalation rates were in the order of 2% per quarter rather than the 0.5% per quarter that we're experiencing right now. And so if you had a 7% or 7 quarters worth of pre-construction still to go on your project, you would have had a $114 million project by the time you were ready to build it. But of course, the market reacted downwards by 14%, and that $114 million project has now turned into an $86 million project, which, if you click it one more time, is a 25% decline. And in fact, if you were procuring your project in 2010, you get another further 5% decline and actually be buying at around $82 million. And that what we at Vermeulen's do is we look at what is the current pricing structure level, and we come up with $86 million in this particular example, and then we tell owners in the market that they were procuring in that you could get very aggressive pricing coming in from a number of subtrades, but it's too difficult to forecast which subtrades will actually be coming in below a sustainable pricing level. So we have been carrying what we call a negative bidding contingency, saying that you can beat a estimate by up to 5% because of those really aggressive pricing structures that you could receive from some subtrades. And the key to our estimating is that we don't want to try and forecast in all of those ultra-low prices because they're not guaranteed to get them every day of the week. It's just sort of particular markets. Each one is different, could yield a different set of subtrades giving you very ultra-competitive pricing. And that those ultra-competitive prices may not be there forever. And so we feel that it's better to estimate at the $86 million level and let owners know that they could buy it for potentially 5% under that, but not to count on it. In fact, what we've recommended is that when you do get a bid buyout savings in this sort of order of magnitude, that owners need to just roll that into their owner's contingency, because in this construction environment, the likelihood of subtrades going bankrupt is a lot higher than it has been in the past, and then having to remobilize and deal with delay claims from all the other subs is going to cost the owner more money. So having that buyout savings in the owner pool is a good place to have it. This represents, on the next click, about 28% down, and I think anecdotally everyone has heard of projects coming in 25 to 30% under budget. And what's interesting is there are so many projects still on the shelf at the $114 million level, because in the fourth quarter of 2008, when the markets were dropping like a stone, all of the projects, capital projects, a large number of them got put on the shelf. One of the things that is really good to do is to recalibrate for today's market because of the substantial differences in buying power that your construction dollars have today. So I'd like to start off with looking at U.S. real GDP. And if everyone was wondering why they're calling this the Great Recession, you can see there with all the negative red bars of how far below the trend line this particular recession has gone in the U.S. It's incredibly lower than any of the other recessions I've shown here, too. The dot-com recession in 01 and 02 and the early 90s recession are considerably smaller than the one that we're experiencing today. And that's why it hurts so much. And the good news about this chart is, as you can see, that in terms of U.S. real GDP, our economic output is at more or less the same level as it was at the time the financial crisis hit. The bad news, of course, is that everyone's heard about the jobless recovery. Well, this is a graphical representation of it. We're producing the same U.S. real GDP with a 9% unemployment rate, whereas back in 2008 we were producing that same amount of GDP with a 5% unemployment rate. And therein lies the problem. The good news is that as our economy starts to fire on a few more cylinders, that we've got a labor pool that can start producing a much larger economic output when we get to that level. Next slide, please. Then I look at the U.S. dollar, and you may say, well, why? Aren't we talking about U.S. projects built with U.S. dollars in the continental U.S.? And of course the answer is yes to all of those. But we live in a global economy, and I want to show how the value of our dollar impacts what we pay domestically on construction. And to set it up here, you can see, please go back one slide. You can see that in January 2002, the dollar was at a relative high. Now, this is as measured against all other major world currencies, like the Japanese yen, the euro, and the British pound. And then by the middle of 2008, it had declined 26% in value, and then it had a bounce up. Next slide, please. Now you compare that with the NYSE, and I think you can all remember, at the end of 2008 there, or sorry, at the beginning of 2008, having a 401k. And then by the time we got to March of 2009, that 401k had turned into a 201k. And then as we've sort of grown out to where we are now, it became a 301K, maybe went up to 351K, and it's sort of set back now because of the debt discussions that were going on in the summer, back to a 301K. Next slide, please. So when you look at the value of our dollar in red compared with the NYSE in blue, you can see that as our 401K was rapidly becoming a 201K, what happened to our dollar? Well, you can see it went up. And that's because people were looking for a safe place to park their money, and it artificially drove up temporarily the value of our dollar. And then look what happens as our 201K became a 301K. The value of our dollar has returned back to the low level that it was. Next slide, please. Then when you look at the commodities, it looks a lot like the equities. And if we go to the next slide and superimpose it on the dollar, you can see what's happening. Now, in the green line, which is the commodities, all through last decade, it was advancing up, and world demand was very definitely driving the cost of commodities. But what is every single commodity measured in? Well, it's U.S. dollars, of course, whether it's a barrel of oil or a pound of copper, they're all in U.S. dollars. And what happened to the value of our dollar? It declined 26%. So 26% of the rise in the green line is just because you're measuring those commodities in a currency that lost 26% of its value. And now as you look at, from 09 and 10 and to where we are this year in 2011, you can see that commodities are on the rise. And again, the same trend. The dollar has been declining. So we are importing construction escalation because of the value of our dollar declining. Now, the other thing that is going on, of course, is speculation in the world and some pickup in world demand, but not very much at the present time. And there's certainly no domestic pickup in demand, yet all of our subcontractors are having to absorb and or pass on to owners the value of these commodity increases. Next slide, please. Now when we look at equities in blue and commodities in green, you can see they both bottomed in March of 09, and they have both had, through the second half of 09, a rise up to a plateauing sort of level that stayed level for the first half of 2010, and then it rose up to another plateau at the beginning of this year. And both stayed at that level until the debt crisis happened in the summer, and the equities bounced back down again. And our view is that both of these charts are sort of a precursor to where we might be lifting off of the current very low escalation rate in construction, which is 0.5% per quarter, and rising up to 1 or 1.5 or even 2% per quarter, is if you look at these two charts and watch the equities and commodities reach to another plateau above the levels that they're currently at. Those will be early warnings of the change from the low escalation rate that we're experiencing now to a much higher one. Next slide, please. So this is a very important slide for us, and I don't know if many of you have seen a U.S. employment chart, and it was very interesting when we started graphing it, both in terms of total employment in our economy as well as what percentage of our total population does it represent here. And so if we look at the blue shaded area in the graph, this is the total number of people employed in our economy. And if you look at where things were in the 2003 sort of time frame, which was the coming out of the dot-com recession, we had 130 million jobs in our economy. And then it grew substantially over the next 4 years and peaked out at 138 million jobs at the end of 2007, which was around 46% of our population were in full employment, and that's why we had a 5% unemployment rate. And then the Great Recession happened, and you can see how dramatic it was in terms of total employment for our economy, and lowered it down to just under 130 million. So we lost about 8 million jobs, and we dropped down to 42% of the population. And that's why unemployment, went from 5% to 10, and then slightly increased now to the 9% level that we're at right now. And this is what I call jogging along the bottom. As you can see, the 42% line is more or less on top of the blue employment line. And so our economy is just sort of holding its own at this 9% unemployment rate. And what we're really looking for is a pickup in the economy where we start lifting off this 42% population line and start creating more jobs in our economy and driving the unemployment rate down. Next slide, please. Now remember I told you we lost 8 million jobs overall in our economy. Look what happened in construction employment. It was a high in 2007 of 7.5 million jobs, and it dropped down to 5.5 million jobs, which is where we are now. It's a 29% decline, and which is incredible. Like 30% almost have lost their jobs in construction. And another way of looking at it, there's over 2 million jobs lost in construction out of the 8 million jobs that were lost overall in the economy. So a quarter of all the jobs in the economy that were lost were in construction. Now these are both construction trade-related jobs as well as the professions. So all of the consultants, the engineers and architects and various consultants involved in the delivery of these projects. This is the total construction sector, and it was so dramatically hit by this recession. And I've put the other two recessions on there to see, in comparison, how large this drop is. Because if you go back, thank you, the dot-com recession was a fairly mild loss of construction jobs. That was in the 2001, 2002, 2003 sort of time frame. And then the early 90s recession was a larger job loss, but still pale by comparison to where we are now. The concern that we also have on this slide is that we're down at the 5.5 million jobs in construction, and you can bet that the 2 million people plus that lost their jobs are not all of them are sitting around waiting for construction to pick up. There's a lot of them out there looking for potential other careers other than construction. And so one of the things that's going to start hitting us sooner rather than later, not next year or anything, but it's going to become a factor, is that we're going to be running out of skilled labor as we start to lift off of the bottom in terms of construction volume. And it won't take nearly as much as to get up to the 7.5 million jobs, because those people won't be there by the time we get there. We'll be lucky if we have 6.5 million skilled construction talent to draw on. Next slide, please. Now, to give you an idea of how the construction labor breaks down across the U.S., we came up with this way of looking at the country. And what we did was we said, well, what is the maximum number of people that were involved in construction, by the time we hit, the beginning of 2008, and call that 100%. And then how many people are involved in construction in the state by state today? And we've color-coded the map. So if you are dark blue, then there are less than 70% of the maximum number of people involved in construction today. And as you can see, the entire West is in the dark blue or cold zone of this analysis, and so is the Southeast, and so is around the Great Lakes. And then across the center of the country is the 70 to 85% band, which is still a significant drop down, and it includes the Northeast as well. And then we look at what we call the warming up states, which is 85 to 100% of their peak, and that they are Texas, Oklahoma, Louisiana, and North Dakota. And that here, this is where we're starting actually to see a little bit of labor pressure on prices in these areas. And also, this is where you can start to be carrying somewhat higher escalation rates than the 0.5% per quarter that I talked about in the beginning of the presentation. Next, please. Then we look at construction volume. And what's interesting about this slide is we broke it down into the three different sectors. Yellow is infrastructure, blue is residential, and then the white or light bluish sort of color is the non-residential sector. And what's interesting here is that yellow, which is the infrastructure, has suffered only a 7% decline and has, off of the bottom, actually risen by about 1.7%. And that's courtesy of the stimulus package, the $140 billion that was directed towards construction. Most of that ended up in infrastructure and has been able to sort of hold the line on infrastructure projects. However, residential, on the other hand, suffered the largest drop, a 66% drop, going from basically in 2006, when the residential started to decline, we've lost 2/3 of the residential volume that we had back in 2006. Now, this is really significant. Right now, at the current levels of construction, we're building about 500,000 new units per year, whether they're single-family or multi-units. It's 500,000 units. And only the household formation rate in the U.S. is 1.5 million. So there's a million home shortfall at the present time, which is being made up of by home foreclosures and vacant homes. And so we have about a 4-year supply, potentially, of vacant homes and home foreclosures out there. And so there is an expectation that the residential sector will finally start showing some signs of life. And in fact, if you look at the number there, it's 10.3% up from the bottom. So it's starting to show some life so far this year. And if you're in certain areas of the country, for example, in Boston, there are a number of large residential, for rental, mind you, projects that are being have gone from the planning stage into the construction stage, and a number of them are starting, have already started this year and are starting next year as well. And this is sort of an indication that there is a shortage in Boston, in this case for residential rental projects, and it's anticipated that as we move out over the next 5 years, that there's going to be an increase in residential demand across the country, which will provide a demand for the labor resources that I was talking about earlier, which will also be competing with the non-residential sector, which has suffered a 41% decline since the peak in 2008. And it too has had a minor bottom. It's only up 1.7% from the bottom, but our expectation is that there's certainly a significant number of projects that are still on hold that could be brought off of hold, that could start driving more volume in all three of these sectors. Next slide, please.
And James, this is John. I'm just going to pose a question to the audience. I'm curious if any of the owners on the call are seeing an impact from these labor shortages that you talk about, and what, if any, impacts are they seeing? If any of these owners on the call or even contractors have insights, please go ahead and just type them in, and then I'll share those with James for any comments he might have.
All right, great. Thank you, John. On this next slide here, I'm showing in the light blue line is the equities, and the dark blue is the construction volume. And as you can see, construction volume was sort of climbing at a rate that was clearly unsustainable. It peaked in 2006, a full 2 years ahead of the equities. And this is, as we all know now, with the benefit of the hindsight, all the subprime lending and the various derivatives and the asset-backed securities and so on that were all part of that process was driving residential construction at a rate that was clearly unsustainable. And that's why we've been in this 5-year downward slide in construction. And it's looking like we're at the bottom in terms of construction volume and potentially rising off the bottom. Next, please.
James, just a comment. So we have a large healthcare owner in Texas sharing that from an accounting perspective, they've noted that more project managers are being put in charge of their own billing, which the result for them is really not very effective or efficient. Sean. So that's just one of the feedback that they're seeing from some of these shortages.
Right. And I think that this is, again, that sort of lines up with the pink zone that we were showing in the state analysis across the country, that the pink states, in terms of warming up states, are going to start seeing that ahead of the other states, and it's sort of the beginning of the change that could continue to pick up across other states as well.
Great, thank you.
Then we look at construction cost indices, and I've put 3 up here so that you can see how they compare. And what's interesting about it is that the indices are created for different reasons, and the blue one is Turner, the red one is Engineering News Record, and the green one is the government statistics. And what's interesting about this is, from an owner's point of view, the blue line sort of tracks what owners have been experiencing in terms of construction procurement costs. And if you were to put our index up there, it would mirror Turner's pretty closely. And that's because both our index and Turner's index are what we call output indices. So they're measuring, what is the cost of the output as experienced by an owner who's going to be buying these projects. And it shows that we're definitely buying below the trendline average, which is that sort of thin line that's going up through there in the blue. However, when you look at Engineering News Record, and Engineering News Record is above the trendline average and has continued to rise the entire time. Now, why is that? Well, that's because Engineering News Record is what we call an input index. It measures the inputs to construction. So the cost of labor, a board foot of lumber, a cubic yard of concrete, and so on, all go in to form the Engineering News Record index. Now, it's a good way of looking at ENR. It's what the subs are paying. And they are definitely experiencing higher prices that they have to pay now. And then they are starting at the present time to pass on in just a modest way those higher increases in their bids, because they're still very desperately tight to secure work, and they have very, very low profit margins on whatever they're bidding right now. But they can no longer afford to absorb the price increases and not pass them on to owners. So the red line is what the subs are experiencing, and the blue line is what the owners are experiencing. And so the takeaway from this slide is that don't use Engineering News Record to index your project if you're an owner. Use an output index like our index or like Turner's index to get an idea of where your project is likely to be when you're benchmarking it to other projects. Next slide. So as you can see, I'll just quickly indicate here, you can, as I was describing it before, the blue line is the equities. They peaked ahead of the red line, which is our construction cost index, which was a full year later. And now we're sort of bouncing along the bottom with this modest half a point per quarter that we're experiencing right now. Next slide. So now when you look at the green line is the commodities. What's interesting to see here is that the peak in the red line, which is the construction cost line, coincides with the bottom in commodities, both in January '02, which is the dot-com recession, and also in January '09, which is our current recession. And so throughout the declining construction price level and the subsequent recovery, sub-trades have to absorb commodity rate increases. And the same thing happened in the dot-com recession as is happening now. Next slide. Then when we look at it in terms of GDP, you can also see that our economy peaks ahead of construction. And we've had the bottom, as I mentioned at the beginning, and we are having steady growth coming out. So far this year has been a lot lower pace, and one of the things that we look for is as our economic output starts to increase at closer to 2 to 3% rate than the 1% rate that it is right now, that will signal a change in the low escalation rate environment that we're in. Next slide. So a glimpse of the future. I like this slide because it sort of illustrates the turbulent waters we've all been navigating over the past 3 years, and also to let you know that if I'm not estimating a project for you, you might find me on a whitewater river somewhere paddling, in this case with my daughter. And if you look in the picture on the right, and you look at the expression on my face, you might think that we're about to lose it in this next rapid. Whereas if you look at my daughter's face, there's a big smile on her face, and she knows that we're going to make it through this big rapid. And in fact, we went on to win the race, and I'm hoping that all of this information that we've been sharing with all of you today will help us all plan projects for the future and have the right escalation so that we end up winning in terms of our projects. Next slide. So to summarize, in 2009, all 4 cost drivers were going in the direction of lower prices. So volumes were declining, commodity pricing going down, labor productivity was going up, and I'll explain how that is that basically from 08 to 09, in 08 you had an A team, a B team, and a C team involved in your projects. And as I showed you on the employment slide, the B and C team basically have lost their jobs, and you're just left with the A team. And that A team is so much more productive that even though you're paying them more per hour, when it comes to installing a ton of steel or a pound of sheet metal or any of the various items that go into your project, that they will install it at a lower price, and that's what has made the market the very buyer's market that we've all been experiencing. And of course, profit margins declined rapidly in 09 as well. And then last year, what was happening was 2 already turned in driving prices up, and that was commodity pricing going up, as I showed you, and labor productivity going down, because now you still have your A team, but you have to pay them more per hour. And so in terms of the price of a pound of steel or a pound of sheet metal and so on, your labor productivity is going down in terms of the dollar productivity. But profit margins have remained very tight through 2010 because volume was very low. But as I indicated, we've seen a small uptick in volume in 2011. Commodity pricing continuing to rise, labor productivity continuing to go down, and profit margins are going to start inching off the bottom because subs can no longer hold on to the very low profit margins they've been carrying because they've run out of the past projects that had decent profit margins, and they have to start covering their overhead in their bids that are being submitted today. Next slide. So then in summary, we have equities bottomed in March of 09, commodities bottomed in February of 09. Both have had substantial increases since then, as you can see. GDP bottomed also in the second quarter of 09 with a 4.9% increase. Employment bottomed in February of 2010 with a 1.5% increase. And non-residential volume bottomed in February of this year with a 1.7% increase. So here's our forecast. And what we've got on this slide here is, first of all, the red line is our construction cost index. And as you can see, it peaked in 08 and went way below the trend line and is currently sort of going up at a 0.5% per quarter to where we are today. And then we have 2 lines that branch off from that, a yellow line and a green line. And the yellow line is what we call a reset to the CPI trend line, which is the blue line. And that we will stay at this level in markets wherever you are in the country where volume still remains low in construction. And therefore, subs are only able to pass on labor rate increases and commodity increases and not really start to pick up some overhead that they desperately need. On the other hand, you may be in markets around the country that are starting to experience the pickup in volume. And some of those markets might be certainly the Boston market, San Francisco, the Texas market, and so on. Those are early sort of markets that are starting to show more volume than the bouncing along the bottom. Now, it may not be all the way up to the green line yet, but as you can see there, as there's more volume, then there will be this tendency to start to increase in the overhead and profit side for subs and generals alike, and return construction pricing level closer to the historic construction trend line, which is the black line. And so we've given you this bracket graphically that you can see. So on the next slide.
And James, there's a question. I mean, based on your trend line in green, or that starts to turn green and catch up. Should owners be in a rush to get their projects out on the street?
That's a very good question, and our advice is that the best procurement method right now is to have 100% procurement documents, so 100% complete procurement documents. Now you can stage it into early strategic packages, like a site enabling package that might involve utilities relocation and earth retention and excavation and so on, might be an early package. Get that to 100% and go and procure it, and then use the time while the hole is being dug to get your structure and envelope package to 100%, and then go and procure that. Meanwhile, you can finish and get all the interiors, including the full mechanical electrical system, and then go and procure that. But the key here is always be procuring off of 100% documents, because as the green line returns and moves towards the trend line, if you are procuring off of incomplete documents, you're, from an owner's point of view, exposing yourself to a lot more risk than the potential reward in terms of buying at a lower point on the curve. Because if the documents are incomplete, you'll have a lot more in terms of change orders and ability to sort of have the price get away from you. So from an owner's point of view, it's better to always procure off of 100% documents. Try and get those as fast as you can, but don't procure early, because you'll get caught with change orders eroding any buy opportunity that you would have got by procuring early.
So there was a comment, as you were saying, that one owner says a lot of their projects are being done as an IPD, integrated project delivery, which goes against the grain, if you will, of having the 100% construction documents.
Right.
What would you say to those owners?
Well, what I've found in the various different procurement packages, that the integrated project delivery, if you're using the IPD Lite version, where you get into the design assist mode on major packages, whether it's structure or envelope or mechanical or electrical, one of the things that really helps owners is to go with the IPD Lite. They can do the design assist and get all of the benefits of having a subcontractor on board to help with getting the design packages the best that they can be, fully coordinated and whatnot. But it still allows the owner, ultimately, if everything works out fine, they can then go and sign the actual construction package with each one of those design assist subcontractors to build the project. But I'm looking at the owner's protection. So what if they're not successful in getting the right price that they want for the envelope or the mechanical package or the electrical package? If you do this IPD Lite with a design assist mode, that then you can make the decision as an owner to say, I'm not liking this mechanical price that I'm getting. I can still go out and do a competitive seam at risk style bid for that mechanical sub package. So that's been our experience, to still give the owner the ability to continue on with the design assist package if everything's working out right, but also gives them the insurance policy that they can actually bid any of those sub-trade packages when it's going against them.
So, Patrick, if I could have you comment on the notion that there's a lot of owners on the call today. Some of them are using eBuilder, some of them are using other tools, and they're tracking their costs, their past cost per square foot, internally from past projects that they have done. And what James is showing here, of course, is effectively a global, or at least U.S. indicators. Was it your thought that as you brought James in to get that second opinion, that to combine both the internal local factors with some of the more national or global factors, and have you seen that be an effective medium to get these owners in the right direction and get them to believe some of the suggestions that I suspect K&K has been making?
Yeah, absolutely. I mean, one of the things we've seen is we're looking at continuous improvement in the industry and trying to foster that as a lot of other firms like Vermeulen, Z-Builder, and others. And one of the things you have to ask yourself is, okay, back in 2006 to 2009, there were several estimates that were underestimated, and it was always the crutch we used as escalation, and there was some reality to that. And then on the flip side, we had jobs that were coming in better than expected in the last several months, last year or 2 years. But some of those jobs didn't come in at 28% under, as James' example showed. Some of them just came in on budget. And so the question we ask ourselves is, have we as an industry servicing clients, have we gotten any better at pre-construction? And I believe that we have not, but I believe there are processes that we could use that are better than the old tried and true, let's bring in a CM, let's do an iterative approach, let's get a, SD documents, DD documents, that type of thing, and estimate on them. So we offer a different approach. Vermeulen's worked within that approach where it's an iterative process, a parallel process. And on large, complex projects, we've seen with the global look that they have, they boil it down to a regional ability, and they really help get the right numbers in place. So a lot of us have been fortunate or unfortunate, depending on where the market's at, with what our cost estimates were and what our final costs are. And what we're trying to do is trying to get better as a whole, so that regardless of the volatility in the economic environment, that we're getting the right numbers based on the scope of the project that's out there, and we're able to communicate those effectively to clients. And that's kind of that's the bottom line for us in trying to find the sweet spot on how that happens.
Thank you.
All right, so if we go to the next slide, we will take this graphical information and just summarize it in terms of numbers. So the peak to the bottom last year was 14% down. So far, we're up 2% to date. And then for the two different curves that are kind of bracketing the extremes that you could experience on your project, and this is where you need to think about, as Patrick was talking about, where you are in the country, what's going on in your marketplace, what is your risk tolerance as an owner to escalation. Does your board say you cannot be over at all, or is there some sort of risk tolerance to escalation that you can absorb? All of these factors need to go into play as to decide what is the right level of escalation for your project in your market. And here we bracket them. So this year in 2011, it's 2 to 4% is the bracket. Next year for 2012, it's 3 to 6%, and 2013, 4 to 8%. Next slide. So process to consider. This is, next slide, please. This is the parallel estimating process that KLMK and ourselves have done successfully on many different projects. And basically, this sort of summarizes a lot of the different things that you get out of doing a parallel estimating process, which involves ourselves and the construction manager working independently to come up with our estimates, and then sitting down and reconciling them. And all of these things are what you can expect. First of all, there's a cross-check on unit rates and quantities off of whatever document set that we're dealing with, say it's schematic design. It's a due diligence and peer review, because most of the major CMs that we work with really appreciate having ourselves involved, because it just provides a second set of eyes to take a look at those documents and uncover things that may or may not have been brought to life. And it provides an additional clarity and value. We definitely check for conflicts of interest where they may present themselves, and definitely uncover opportunities that part of the, I remember back to working on several projects with Partners Healthcare up in Boston area, and John Maservi has said that what he likes is he gets information early so he can make decisions early on in the design process rather than sort of going down a certain route and then having to backtrack. And that's why the save design costs. And we end up creating new ideas, and we can be a focus point for the team. It allows discussion about all different aspects that are driving the cost on a project. And then as we go through it, it also uncovers potential value analysis ideas that can be brought to discussion. Next, please. Here's just a sample of what we do in the parallel estimating, where we first of all kick off the project. We want to make sure that our interpretation of the areas are correct between the CM and ourselves and the design team and so on. We develop an elemental estimate, which we can sort into the trade format that construction managers will be using, and then the reconciliation meeting that I talked about, and then a back-on-budget cycle if necessary, and then finally the milestone estimate at the completion of each design stage. Next. And in the reconciliation process, we do it real time. We have a spreadsheet that we just track all of the pricing between the CM and ourselves, and any decisions that get made along the way get entered into our real-time spreadsheet. And involves the entire team. What's really great about the process is it's not just the CM team and ourselves, but it's also KLMK's team, the owner's team, and the design team, all involved in this on a consensus basis to arrive at what is the right set of assumptions for this particular project and the market that you're in terms of program and scope and quality levels. And as we do it, we always know where the bottom line is all the time because we're incorporating any reconciliation adjustments real time. And it creates this living document that becomes the event log of the reconciliation meeting, which records all of the decisions that were made so that then both the CM and ourselves can go away and update our estimates to reflect all of the reconciliation items. And it fills in any holes because we'll have discussions about things that may not yet be on the documents, and there are two different sets of assumptions from the CM and ourselves, and allows collectively the whole team to choose the right assumption to fill that hole. And finally, we also talk about establishing the right contingency levels, as I mentioned before, escalation being one of them, that everyone feels comfortable for the project. Next slide. And here's an example of the real-time reconciliation spreadsheet. The first three columns, which say VCC, CM, and the delta in the blue sort of color. And as you can see, these are the as-published numbers before we sit down and reconcile. They're multi-million-dollar deltas across many of the trades. And then after the reconciliation meeting, you can see there's very close alignment. We're both at around 174 million. We're within $250,000 of each other. And this is the consensus that we're able to achieve on every single project. And now you have 174 million is the value that both CM and ourselves feel is the right price for this project in the market that you're in.
And I want to add to this. I mean, typically, if you don't have this exercise, you're looking at the CM's number. You're saying that's the number. There's obviously some things that you find that are scope overlaps, that type of thing. Perhaps you're carrying, structured cabling, nurse call systems, that type of thing, and they're carrying it, and we can pull that back. But more often than not, you get to a point where you don't have the expertise in the room to do any further reconciliation, and then you start turning to, okay, value analysis, value engineering, whatever you want to call it. This process is done before you even get to that point. So you can see in this example, the CM's number was at 182 through a reconciliation process, looking at labor rates, looking at unit prices, looking at scope overlap, or things that they may have misread on the plans, or they may have inferred something different than they should have. Through that process, you get them down to 174 million, and that's before you've had to consider anything as an owner that you may have not wanted to do through the value engineering process. So I think in and of itself, that is where one of the prime value points of this process is.
Yeah, and then in summary, basically the parallel estimating process provides this huge value to establish what the right pricing level is. In the last example, it was $9 million less than where the CM started, and but regardless of where it ends up, it now is a price certain level that everyone can start making decisions on, and you can measure from that point to where you need to be in terms of how much value engineering is necessary, or did you get all the way there? In the example of that last project, $174 million was the budget, and so there was no need for value engineering moving into the contract document stage. So it's a very, very powerful tool that gets you to the right budget level early on in the process. And then the other points here are construction prices have bottomed. They bottomed last year. We're in this modest 0.5% per quarter sort of escalation regime right now. But you must factor in escalation, and you need to decide where you are on that continuum, whether it's a reset to the CPI trend line or more up to the previous construction based on the market that you're in. You need to factor that in. And then finally, as I indicated on some of the charts there, that the equity markets are sort of the first mover of all the macroeconomic indicators. And as they go, it starts to show where the confidence level in our economy is, and therefore creation of jobs and the higher economic output and so on. As those things all start to improve, then you can expect to see much higher escalation rates in construction than the 0.5% per quarter that we're experiencing today. And I think that wraps it up for now, and I don't know if there's still room for questions, John?
Well, we're a couple minutes over, but there were two final questions that came in. Maybe you can hit these and then note that the recording is, the webinar is being recorded, and Sergio is going to be able to put that up online for others, that those who are on the call that want to send it to others. So the two questions are, what is the percentage that you factor in for escalation in your experience, is the first question.
Right. Okay, so I had it on that previous slide, about 4 slides back, which is here it is. So for this year, it's 2 to 4%, depending on where you feel your market is, and also your risk tolerance. And then next year, 3 to 6, and the following year, 4 to 8. And and these are escalation rates to procurement date. This is how we look at things, that all of the pricing that we track is as procured numbers. So they're procured generally at the beginning of the project, and so those are the escalation rates that you need to carry to whatever procurement date you're looking at.
An important point here for everyone on the call is, because of the way they look at that, if you're doing early packages, you have to look at that number differently. You know, you have to look at it on a per package basis of when that package is going to be procured. You know, especially on larger projects where the numbers are much bigger and you can see much larger swings.
Great. And then the follow-up question was on the reconciliation tracker slide. The comment was, it's very compelling. But the question is, have you tracked your trend or your accuracy of what you initially came up with, and then what it actually was at the end?
Yes, we've been tracking that, and generally we're at the end within 5% when you normalize for sort of major scope changes. This particular project, what's very interesting about it is that we encourage owners, as was the case with this particular example, to spend more money in the concept stage in terms of design work to figure out what your project is all about, and in fact having a CM involved and ourselves in that concept stage to work through the different combinations of what the building and project might be, so that then you can decide which is the right business case that fits whichever one of those construction conceptual models to move forward with. And as in this particular example, at the end of the concept stage, we had a $174 million project that then went really smoothly through schematic design, design development, and contract documents. In fact, this here is an example that it reconciled to the budget, so there was no value engineering required at design development, and then it was subsequently procured at $173 million, $1 million under the $174 million budget. So basically, the real takeaway here is spend more money, and it's not a lot more money, but in the concept stage to really define your project, because then you can get a really good handle on the cost using this parallel approach with ourselves and a CM at the concept stage to get you the right budget for your project, and then you can have a smooth design sequence through SCDD and CD.
Great. Well, Patrick Duke with KLMK and James Vermeulen with Vermeulen's Cost Consultants, I want to thank you very much for presenting this very informative, fact-based presentation.
Thank you, John, and thank you, Patrick and James, as well. Gentlemen, thank you for a very informative session. We'll make the recording available, and obviously, as you know, we do a great job of sharing this information as part of our knowledge sharing initiative. So I'm guessing you're going to get a lot of questions in the next couple of months from different people that will get access to this presentation. So unless you guys have anything further, I'd like to say thanks again and hope to see you guys soon in another webinar.
Yep. We appreciate everyone's time today. Thank you.
Yeah.
Thank you
very much.
Bye now.